Hello, the Chartprofit video, Friday 8th of January, approaching about 4 hours into the trading day. Start with looking at the pre-open graphic today. It's a pretty weak looking market. If we look back a week, we had aggressive selling marked up here last two trading days last year. The market and the price locations that they're in currently, really weak price locations. We're looking for minimum of significant buying being marked green. What we've had this week actually is an attempt by the buyers on Monday through Wednesday, so intraday net buying volume numbers here and here are all positive. So there's an attempt by the buyers, but completely ineffective. So buyers active on this time frame, daily time frame, completely ineffective in terms of lifting these value areas. So we just managed to range in this area here, and that looks more like sellers resting. So on Thursday, gap down below the support of 1965. In here we had that probe up into what became resistance on that half range. The value area was printed entirely below it. So again, that's weak price location. Breadth numbers that we'll talk about really weak over here. Momentum indicators really weak. We'll talk about that as well. They turned down again on Monday, and then had the real concern in the sentiment, this RIDEX ratio. Again, we'll go on to talk about that. So this is the market chart for New York through yesterday's close. Looking at the daily breadth indicators at the bottom here, getting oversold readings definitely, but on the time frame I like to consider, what I look for is these two indicators at the bottom here. The net new highs 25 indicator, 5-day moving average, that's the black line. Like to see that above 0, that's supportive. And the percentage stocks greater than their 50-day moving average in my New York list, like to see that above 50, which it's not. Those two numbers give us a red, grey or green, and of course we've been red since here, along with price momentum, which has gone negative, and unfortunately at the start of this week turned down again. So pretty poor combination, very weak looking pulse chart. Just to remind you, the colors on the top here, the red and the green, the significant buying that I extract from the pre-open chart each day and transplant them here onto the spider chart. Again, you can see we've had some attempts on that time frame. These green bars here, really not amounting so much upside in light of this kind of poor looking scenario at the bottom here. You can see that when the buyers came back in at the end of last year, they're much more effective in this kind of environment, this weak environment. So here we are on the spider, printing below the half range here, which was off last year's high, down to the low. It's an important support level. You also notice, just to remind you, the time support resistance level up here at 209.90, significant resistance, and we're now in a really weak price location here with the next major support back at the time support at 187, which was the low in September. So in light of all this, just really weak looking market. I wouldn't attempt to look at the long side at current levels unless we see buying coming in off here, or we manage to climb back above 198.10, the half range, and we get some significant buying. So this is the current spider chart here on the live chart. Hit a new low today over here. Just to mention a couple of key charts and levels, and the key support I see on the diamonds actually at 164, and now that was previously the major support or the major point of control, which did migrate higher, but that level should in theory still provide significant support, we hope. And going into today's bar here, there's the support. So I'm watching this chart because if we see time printed below this level, that would be extremely weak. It'd be a negative indication for the general market. A quick look at IWM Russell 2000 ETF. This chart unchanged in terms of the levels that we've marked. Looking at the major distribution pattern on this chart, we have this value area high up here, which we noted, just that probe there, a quick rejection down below the major point of control, which again we've been watching for many months, probably years I think, and that is a really poor pattern. It's a lower high against a major time level, and you can see the severity of the sell-off from there, and we're now breaking below the value area low. And when we don't get a response, as we did here and here, to a value area low, it suggests that something's shifted and we may be in another major distribution. So that's a little alarming. Really want to see the market climbing back quickly on the 2000. Just to review the couple of European charts here, this is FTSE 100 index. So from the significant high up here to the subsequent low, we have this halfway point, which was, we watched this right the way across here, all this resistance. That's the major level to watch off a new high to a low. It's just that halfway retracement, which unfortunately was clearly resistance. We then had 63.35, the 8-month, and that actually on the next bounce didn't even get probed. We're back on or close to this 58.70 level, which is the major. That's the big one. That's the big time level, which has supported the market here, approximately here, and definitely here. And time below this proven level, which we know is significant anyway, would be really weak price location for the UK FTSE 100. Again, hoping for a quick rally off that support. And again, looking at the obvious levels on the DAX, the German DAX, from the important high to the following low, we have this halfway point here in blue, very close to the 12-month, just above it. So that's a very obvious sort of area of support resistance. This was encouraging, this probe above, but then we had the lower high right bang on it, which is really weak. You'll note that we've bounced twice again off the major level down here at 93.07, and the half range off this low to this high, which comes in here. Again, we're printing weak below that level as well, so again a weak looking chart. Have a look at the sentiment indicators, particularly this RIDEX ratio, which I've been talking about this week. So we'll have a look here. Tuesday I mentioned that the RIDEX assets ratio, or my version of it, hit 9.17, a 4-month high. It was quite recently on the 29th of last month. And with the S&P on Tuesday, by Tuesday, down 4% from that date, the RIDEX ratio only down about 11%, and that's not enough. And as I said here, it indicated complacency from the RIDEX traders, and that's not usually bullish in the short term. You want to see more fear, measurable fear, before we look for any kind of a low that's put in after a fall of 4%. We've obviously fallen more from that point. That was on Tuesday. Saw nothing on Wednesday. The ratio barely moved, but saw a little bit of a shift because on Thursday the ratio fell to 6.59, which was a 45-day low, and that was approaching the 30% fall that we usually see if the S&P is down 5 or 6%. So I said this indicates some fear. So this is the ratio itself at the bottom here. At the top you can see the S&P, the spider. So just from this period here, this chart at the top here, the spider came off quite severely, and the ratio kind of to this point was doing nothing, which indicated complacency. We have now seen a little spike lower. My hunch is we'll see, I'm kind of hoping we'll see the ratio fall pretty swiftly, and maybe today, and we're down on a 45-day low. So I've just been tracking this kind of number back for a while on the charts, just showing them more recent data here. So this line representing a 6% fall on the spider from a 50-day high. So you can see kind of here and here, and there's a lot of these historically, and we would normally expect to see the ratio below this blue line, which is a 30% fall from a 50-day high, showing some degree of fear. We were almost there at that point yesterday. And a kind of similar looking chart, if I just look at the bull fund assets that I follow in isolation. So bottom black line is the RIDEX bull fund assets, the red line being 30% from 50-day high, or 30% fall from the high. A little bit more history here. And again, you can see when looking at the bull fund assets in isolation, they usually fall about 30% from a 50-day high. The S&P is down about 5 or 6%. And we just about achieved that yesterday here. Just quickly looking at the bear fund assets, you can see again the spider has fallen but there's not really been a big pickup here in the bear fund assets. I might need to see that as well. Interestingly, if I just look back to the bull fund assets here, going back to the start of 2012 or more or less, these are 6% corrections, let's call them, in the S&P, and you can see generally we'll see cumulative bull fund assets down below this level, and we're not there, or as of yesterday, not really close. Sometimes the S&P will make its low, start to rally, and we'll continue to see the assets falling, the bull fund assets falling. So it can come in, or the fear can be shown on the rally, kind of selling the rally. And again, that's pretty useful from a contrarian point of view, but this is not. So I'd be interested to see how this indicator looks over the next couple of days. Looking at the consensus polls, this is the public poll from AAII. Bulls percent was lower, 22.2, and the bears percent was sharply higher this week at 38.3. So the net, the bulls minus the bears, is at minus 16.1. That's the lowest since the end of July, which was here, this one. So currently more bears than bulls in this public poll. Looking at the exposure index, which is a measure of the current equity exposure of active money managers, that was slightly higher this week at 50.26. Previous week 47.67, that was the lowest reading for 10 weeks. We've had a sharply lower S&P this week, market this week. Money managers' equity exposure currently indicating that they're no more concerned than they were 1 week ago. This is around 50, a kind of a neutral reading, I think. Data from Lipper US fund flows, they reported equity fund including ETF outflows of 12 billion. So it's an outflow this week of 12 billion to the week of the 6th of January. The 4-week flow, the black line here, that's actually a net outflow over the last 4 weeks, 22.8 billion. And if you remember 2 weeks ago down here, the 4-week flow reached a negative 30 billion. That's a very low reading. Remembering these are contrarian indicators. Okay, I'm going to quickly run through some other charts. Looking at bonds here, 7 to 10 ETF, this is IEF. The two levels we've been watching for a good while are the 18-month time, 106.60, and this major one down here at 105. Interesting, as we noted at the time, that held the decline through October quite clearly, and we ranged backwards and forwards between those levels. We're attempting currently to print above that, and my idea over the last couple of weeks is that a clear breakout from these two levels may well signify or indicate the next directional move, which is currently looking quite positive. This is investors looking for a safe haven. Just from the chart perspective, that's pretty significant, I think, and if we hold above that level going into next week, it puts this chart in a stronger price location. I'm not sure it's going to be an extended move if we do that, and much to get excited about when we look back at it later if it occurs, but we don't really know, do we? And the best we can say is that this chart looks to be moving into a stronger price location, not necessarily good news for equities. And GLD, the gold ETF, although in the longer term wouldn't look at the long side currently, we are seeing that safe haven bid there as gold has rallied this week. If we look at oil here, closed below 2008's low at its lowest level since 2004. I'll just show you the chart. It looks like this, and the weekly looks like this. Dollar index is a frustrating chart. Finding it difficult, but I think what's happening, obviously we're printing in a strong price location longer term above this level, 95.22 down here, which is the 12-month time. From this high, the previous high, down to the low here, we had a halfway point here. As we know, that was pretty bullish, the sort of consolidation pattern above the half. We just probed above the March high, and then quickly retraced from there, and we're looking at this short-term half range just to give us an idea of strength or weakness in the short term. But I think what's happening, I'm not going to show it here, but on the price distribution chart of various time frames, I think more time here could lift this level, and I think that may be what's going on. Price around this current level, somewhere in the halfway point here, is attractive, and value may be about to migrate. When that happens, we will monitor the chart closely. We know that a migration of a controlling price of a high degree like this is usually precursor to a directional move, so we start to look closely, and that would be interesting. Maybe some more churning around this level here, and almost the mirror of that chart is the Euro FX, and something similar happening here below the really important levels up here. Weak price location, and I think the level here, the red level here, the point of control, could shift down to somewhere in here. Most likely, I think that would be a negative, and we'd see this chart heading lower to a new low if that occurred, with the dollar index probably heading up to a new high above the March high. So again, closely monitoring that. The pound looks really weak. We noted the pattern off the April low to the subsequent halfway point came in here, and that pattern was weak at that point. We mentioned that. I did mention possibly when you see that kind of pattern, often suggests a retest. We've seen that now. So we're down, broken below last year's low now. If I zoom out, you can see that here it was back in April. And finally, the Aussie dollar below these two really major resistance level. And I've been saying for a good few weeks that this obviously is weak price location down here, but I had the feeling, just the relative strength that was being shown in the Aussie dollar, that this was maybe a base forming here, but I think maybe there's just too much time being spent here. Would have expected more of a positive move, and again, looking at the price distribution chart, there is a danger of quite a major let's call it controlling price shifting lower, migrating lower, which again would be a negative for this chart. Interesting to see what gold does at that point. A negative for this chart, but again, if that occurs, I think all these charts may move together, and this would be the kind of big lift for the dollar. We'll see if that pans out. Okay, I'm going to conclude there. I was going to wish you Happy New Year. You might think if I do, I'm being cynical considering the week that we've had, but I'm going to do it anyway. Happy New Year. Let's hope for a better one in 2016. Most importantly, let's monitor the charts really closely. Thanks for watching.